Could you tell me, yeah, how did you get started doing this type of work? I know you've been doing it for a while, right?
I got involved in lending and investing really by accident. A friend of mine was in the mortgage business. A friend of mine, a realtor at that time, wanted to borrow some money for a flip he was doing. I had the money personally. I lent him the money and it was like, oh, that was kind of fun. That was kind of nice. And I stayed in investing because I've tried flipping. I'm horrible at it. Can't work with the contractors. Everything I seem to do, I do wrong in the flipping side, but in the money side, it seems to work better for me.
Okay. So it was lending?
That's what I've always done. I'm the funding side. If you look at investing, it's all about using other people's money. It's all about leverage. If you don't use other people's money, you're not creating wealth. You're not creating income. Because if it's just your money, you're not going to go too far. In real estate, you have to learn how to use leverage and use it correctly.
So like it feels like with my wife and I, we're often told that like the key is to budget well and save. And it sounds like the save thing, there's something like there's some like contradiction there with like save up all your money and let it grow a tiny bit versus like using other people's money, using your money.
Well, I think there's two philosophies, and using other people's money correctly and using debt correctly. Because there's people who use and abuse debt and they have every toy in the world, but it's not an asset. Real estate investing is all about using other people's money to buy assets that create wealth for you, pay the other person you borrowed the money from a good, return, but it puts you in a situation of growth. You can't grow by just saving. You can't grow by just putting money away, or at least most people. The majority of people who are investing start with little to nothing, come from all kinds of backgrounds. They may, there's a lot of people who haven't finished high school or college or whatever. Education doesn't matter. Where you come from doesn't matter. It just depends that you're willing to take a little bit of risk and use other people's money.
Okay, so if I'm trying to get started in doing this, what kind of hurdles do you think I'm going to face? If I buy into this, I'm like, okay, yes, I want to use other people's money. I want to generate wealth that way. That's the way to do it. What do I need to look out for?
Well, it's just setting it up right, setting up correctly, and don't let emotions take over for your investing. People usually get greedy and start, letting their emotions take over for their investing, and they get in and they start buying properties that are not profitable. I mean, investing is all about numbers. If you could take away the emotions and just leave it for your energy and putting it into the project, better. I see so many people want to do 5 or 6 deals a year and they lose money on 2 or 3, and at the end of the year they break even, instead of just doing 2 good deals and making money and growing it. In 3 years you could have good wealth, but in 1 year it's kind of tough just starting out. You want to make sure you do this strategically so you're making money on each deal.
It's interesting. I see this. I feel like I've seen this in my own life in other arenas too, like where you get excited about something and you're like, oh, I must expand. I must scale this idea. And you're saying that can backfire.
Well, I've seen it backfire more than it. Probably 80 to 90% of the people who try to do too much or let emotions get in, they know their numbers going in, and then pretty soon you're bidding on a property. And they're like, I could just go another 5 or 10, or I could pay my realtor another 1 or 2. Pretty soon their numbers don't become profitable because they're stretching. This business is designed for anybody and everyone, but it's designed for people who could take the emotions and put it into the energy of the property and not the purchase. As they say, you make your money on the buy in real estate investing, and it's so important that you leave the emotions on the side and then make sure you understand leverage. You have to understand how you use leverage properly and how that is going to create the wealth and income.
Okay.
Because not everyone has, $300,000 to start investing.
Besides me, I've got that and much more.
Yeah. So you're golden.
No, not at all. Yeah. So for those type of people that like I would say the average person, like me, very little savings. You talked about leverage. It sounds like there are ways around not having great savings and being able to,
Leverage is the whole key to real estate investing, using other people's money and taking real estate and putting those two together to create wealth over time. I mean, and some of that time could be 1 to 3 years, but typically it's like, how do you build wealth over 10 to 20 years and how do you create that? So that's what it's all about, is finding the properties. But the other half that a lot of people just don't want to look at or deal with, that is the people who do this right understand leverage and how to use leverage correctly, because they know they don't have the money to do it. We've had people easily in the last 3 years add 100 properties to their portfolio who started with little to nothing. It's because they just started and started learning how to use leverage in other people's money. And leverage is key to anything you do in real estate. If you don't use leverage, you're not going to make really any money in real estate. Or it's just going to take you too time. If you want to save, 60 grand for a down payment, how long is that going to take you? 3, 5, 6 years? If you're going to use leverage and find the correct properties, you could, start in 2 to 3 days.
My wife and I have saved $30K, and that took a long time. So what is this alternative? Can you define leverage a little more broadly for me, some understanding?
So leverage is just taking a small amount of your money and using someone else's money for the majority of it. So let's just say you're finding a real estate investment that's $200,000. You don't want to put up the whole $200,000. In pure real estate investing, you find a property that is undervalued, or what they call it a value add. So it's something that someone wants to get rid of. It's just a property they don't want anymore. You buy that property for $200,000. Maybe you put $10,000. You use someone else's money, a bank, a private lender, hard money, whatever it is. You use their money for the 80 or 90% of it. So that's the other part. That's you're leveraging their money with part of your money to buy this property. Now you put in, or you use their money again to leverage the fix up. So we bought a property for 200. We're going to put 30 or 40 into it, and now it's going to be worth 300. So you just leverage 10,000 of your money using other people's money to create an asset. Because you paid 200, you put 40 into it, it's worth 300. So you had 60 grand of net worth you just created.
Gotcha.
And over time, if you keep that as a rental, you're going to put it into a loan. It's going to pay all the way down, and that property is going to be yours sometimes. You're going to get the income, but you're also somewhere down the line going to have a house that's kind of like a 401k because it's going to be there. You could sell it.
Like a nest egg. Yeah. Okay.
And that $300,000 house when you retire is probably going to be worth $1 million.
Yeah.
Because it's also going to grow. So that is why your 10,000 using other people's money, you now created that leverage. You took 10,000 to buy a house for 200,000, and you created that 60,000 of wealth now, but a lot more in the future.
And then the person who gave you that loan, that leverage, they get a cut of that, but you do as well.
They do what they want. I mean, these people are more comfortable lending money instead of fixing up homes or renting homes. Everyone has what they want to do. Lenders want to lend. Investors want to own properties and everything else like that. So it's a win-win situation. They get interest. So every month you're going to pay them some interest. You're going to, if it's an amortized loan, you're going to pay it down. So they get what they want and you get what you want. It's not like you're, competing or cheating them out or something. They're getting exactly what they want and you're getting what you want. It's a win-win situation.
So when you're talking about leverage, it's the classic version of this, like a mortgage?
It's a mortgage, yeah.
Okay.
When we talk leverage, we're talking funding loans, mortgage, lien. There's a lot of different words that are out there, but it's probably the most common is mortgage.
Okay.
Typically in our world, it's a short-term loan to buy. And as a real estate investor, how you also leverage everything is buying undervalued properties that have like someone just left a house. I just had a friend who's just buying a house, just helped someone move out this weekend. It was a hoarder house that people were in foreclosure, just couldn't get everything done in time. They just needed some money to get out. They didn't want the property anymore. He came in, gave them some money. They got what they wanted. He got a house now. He's buying at about 70% of the value. He's going to put 10% in. So he's going to walk into 20%, create 20% net worth for himself because this house is I think it was going to appraise for about $250,000. It's a little condo. So he just created $50,000 in wealth. How long did it take you to save 30 grand?
Like 5 years.
Yeah. So he just did that in a weekend, more than that. He just created wealth in a weekend. That's what real estate investing is about. And like I said, the beauty is it doesn't take a PhD, a master's, anything. It really takes some, we call them doers, people who want to actually get out and do it, just do it smartly.
Wow, yeah. And those are great rates of return, right? Like to my knowledge, like if you do a, I don't know, like a 401k or something, you can expect, 6 to 8% or something. Or that's really those are
I think
generous
time,
estimates over long periods of time.
Because if you look at the last few years, everyone's
last few years definitely not. Mine's not looking great.
Yeah.
But you're saying that your friend just made 20%.
Yeah.
Yeah.
We've helped many people. I remember a guy here locally, he had to sell his car to get his first deal. It was probably 4 years later, he built 3 sixplexes with cash and owned them and was renting them. So he went from nothing.
He built what? Sorry?
3 6-unit apartment buildings.
Oh, okay.
With the cash he's made over those 3 to 4 years, owned them free and clear, and just created, steady income for the rest of his life plus an asset. So that's what he did over time. He worked his butt off. He did everything he needed to, and he was very diligent on his numbers. But it's not, it's not abnormal for the people who put their mind to it to create the wealth they want. Because people like him, he wanted to create that, but there's people who just want to make 50 or 80 grand a year and have 6 months off. That's the beauty of investing. You could.
It sounds glorious.
So that's what leverage will do for people.
Yeah.
Is help them take with whatever they have, even if it's just knowledge. Because if you find the right property, you could get 100% financing.
You don't have to put anything down.
Yeah, on a value add, which means you're buying something under market. Because just look at it. Like, let's say you're buying a car, and a car is worth $20,000, but you have a neighbor that's been in their garage for 5 years, and they're going to sell it to you for 10 grand. So what's that car really worth? On the market, it's worth 20, but they're going to sell it to you for 10.
You get 10 grand out of it?
Well, so lenders look at it like this: is like, hey, if you're buying something under market, like you're buying a car for 10,000 that's worth 20, I'll give you the whole 10 grand because I'm safe because you had such a good deal. Housing is the same way. If you go out and find a house that is well under market and they're out there, people are still buying them, and people are, like in this market that doesn't happen. It happens. It's happening all the time. We see it. We do loans every day on people buying properties under market. A lot of them need some work. A lot of them need some, TLC, but that's where it is. You have to put in the work to get that equity out. I think what a lot of people think is like it's easy, and it takes some work.
Yeah. It's funny. What I keep thinking about as you're saying this is, and you said you did not want to talk about this guy anymore because your son, if I'm right, was really into him. But Mr. Beast and the entire genre of YouTube that he has spawned is just based on sound investing principles, is what it sounds like.
Yeah.
Because he's going out there and saying, I'm just gonna I'm going to put money into this and then just put it all back into the project.
Yep.
Work. Like there's one guy that he starts with a penny in Paris or something. This dude, yeah. Yep. And then he's like, I'm gonna figure out how to get home with the penny, and so trade it up.
Went through U.S., went through Europe, went through.
It sounds like that's kind of the similar principle. Yeah. Okay.
But it's kind of the same thing. But Mr. Beast, I forget the other guy's name.
Yeah.
The one thing they're doers. I mean, like Mr. Beast plugged along for a long time, getting things right, getting things done. He lives in his warehouse. That's probably to the extreme, but he is to the extreme.
Yeah.
And there's other people on YouTube who make a really good, doing less, because that's what they want. They want a life. I mean, this is supposed to give you a lifestyle, a life. That's what real estate is supposed to give you. So not everyone wants to be a billionaire or a multimillionaire. Some people just want to replace their job with rental income or fix and flip rent income or put their kids in a school or pay for college. Some of it is just part-time, and you could do that part-time too. That's the beauty of real estate, but it all comes back to, in our world, leverage. You have to find a good deal, but you also have to have the right money to buy it. Because if you find a deal and you don't have money, you don't have a deal.
Okay, so if let's say my situation, right? We've got this money. We've thought about putting it in the stock market or something because we were gonna get a house 6 months ago. Didn't work out. We actually were under contract and everything, but then I left my job, so it was like, oh, I don't have the money anymore. So
guess what? A lot of real estate investors leave their jobs.
Yeah. Hey, so
they are.
So if we want to do something like this, you said, and I think a lot of people would think this is like a dream for them, right? Is I'll work really hard and then I'll take off a good chunk of the year because I made all this money at once. For someone in our situation, we've got, I think it's about 30 grand. But otherwise we're pretty normal. We have decent credit, so that helps. But otherwise we live in an apartment, we have some credit card debt, not a ton. How would you, if you were in my position, how would you all right, I'm going to go make some wealth right the heck now. How would you do it?
Well, I know real estate, and I don't know, I don't know franchising or anything else. So if I was in real estate, I would take a step-by-step plan on how to do the two big things. Make sure I get the right leverage and make sure I find the right properties and understand those. But it also takes some time. I'd take like a couple months to research both and find out and test a few things. Anybody who calls in and they're like, hey, we're just starting out, I want to know my, like I want to go through and tell me how much I'm approved for this. And I said, let's just actually go through a live example. Like find a property and let's go through the numbers so you understand everything, because we have everyone from like, hey, I just found this property, it's worth 100 and I'm going to buy it and put in, like 80 and I'll get 20 grand out. I'm like, wow, there's real estate fees and there's title, like an example. And if I was going to start this, I would start it as like, let's run through a couple test runs before you go live.
That makes perfect sense.
And then set up how you find properties and how you get money. If someone could take the time to spend a couple months doing that, it also gets rid of some of the emotion that they have to do it. I think when you have to do it is when you get behind the eight ball a little bit and you start buying stuff you shouldn't buy. And then a year from now, you wish you wouldn't have gone down that path.
Yeah.
Or ran up credit card debt or whatever it is.
That resonates a lot with me. So this will sound totally out of left field, but I feel like it really connects. Like I played video games when I was younger, but I didn't for a long time. I got in this whole like, I'm gonna be productive, I'm not gonna waste my time like my friends. And I was like that for like 10 years. And then recently my wife and I were like, we need to have more fun. We don't chill out and do things, We're just like both really ambitious people. So we got a Switch recently, and I was like, it just like sorry? Yeah, I'm sure. Yeah. We play Overcooked. I don't know if you guys have played that one, but it's this like stressful restaurant game where you're like chopping up onions and we're like yelling at each other, but having a great time. Like, give me the onions to put in the, So like, but what I realized is the mentality of playing the game is like, you just kind of get in there and start doing stuff. And as I've been working on my video business, it's the same sort of thing. It's like, I don't learn very well. And this is what I'm hearing you say basically with real estate too. Like conceptual research, reading articles, you're saying like, get in there and like do an example or like a small investment, like actually start a project, get your hands dirty, and you'll figure out all the like the nitty gritty stuff that happens down the road.
There's a couple ways to get in. If you're talking about getting in, maybe it's finding a good flipper right now and invest with them and then walk through with them. Like get mentorship, put your money in the deal. You got to be very careful that you're not handing your money over to someone who is not going to be very careful with it, but they can mentor you through it. The other thing is I always, like I'm going through the 12-week year myself, which is a program on how to do a year in 12 weeks. And part of it is just setting yourself up to do 3 things during that 12 weeks. In your case, if I was starting out, every day I would get up and I would look at properties and I'd contact realtors or wholesalers trying to find properties. Because, the first time you contact someone, they're going to be like, yeah, you're a new investor or whatever. But you talk to them a couple, 2, 3 times. They're like, hey, we actually have a deal that fell through with someone else. Here's the deal. Same with lenders. Like every day you're building your database. Every day you're building data. Every day you're looking at properties. And I'm talking 15 or 20 minutes, not, 8 hours a day. If you do that in 3 months, you're going to be probably a lot better off than most of the people who just jump in and swim. Because my experience over 23 years is 70% of the people we see who come into this lose money. Their first year, probably get out of it. A lot of them go to classes and put 30 grand on their credit cards, and then 0% leaves because that's what they were sold on, and then they haven't done a deal. And so they're trying to do and make all that money up front and if they just took some simple little steps to make sure they're looking at properties, securing people who could send them properties, and securing the money, in 30 days it'd be pretty good.
Okay. Yeah, like go over that distinction a bit again, like that difference between, because I have seen this happen too. Like my dad's gotten into stuff like this, like people that are like, just go out there and buy, and I'm like, buy this and sell it and you'll make money. And he lost a lot of money. He didn't make any money. So what do you think people should look out for, and how can you make money instead of losing money on this?
What I've seen other people do is they go to these seminars and they pay everyone from, I know Trump used to have one, but they go to these seminars, they get talked into how easy it is. And believe me, as they say, it could be easy, but it's not simple either, or simple is not easy, whatever. This is not rocket science, but you have to do certain things. So people get into these places and they get talked into paying $10,000, $20,000, $30,000 for these courses on how to flip.
Okay.
So they're already behind the 8 ball because they probably just spent 20 grand of their money that maybe they didn't even have, because they teach you how to use credit cards to buy everything, to buy their courses. So we see that method of like, going down that path, buying the course and then just not doing anything with it, because then they lose steam after 30, 60 days, because they are not really talking to wholesalers and realtors and people who are in the business and out there looking at properties. The other thing is they jump in too quick and they just buy something because they just like, I just need experience. I don't care if I make money or not. And guess what? They don't. They don't make money. And for the majority of people, if you don't make money, you lost 20 or 30 grand. Now, how are you supposed to buy the next property, or how are you supposed to be profitable? The people who take it a little bit slower and, you know, make sure the first 1, 2, or 3 are good deals. Instead of doing 7 their first year, they do maybe 2, and they're good deals and they return some money. Then the next year they do 3 to 5 deals and they could get up to 10 deals. Those are the people who succeed, is they make sure every deal makes money, because that's the only reason. Real estate investing is just about making money to live the life you want.
Mm-hmm.
It's not, you know, not everyone is in love with what the whole concept of real estate investing is, but it's just like any other thing. It's like, how do you maximize that with minimal time to live the life you want?
Yeah, it sounds like it's about ROI, going slow, like the return on investment, making sure each deal is profitable. Yep. And also just like the, you know, grandma's old advice, if it sounds too good to be true, it probably is. These courses that are promising, you know, insane returns, because they got to be promising something pretty wild for people to shell out 20 or 30 grand.
I've gone to them. I mean, their whole thing is slick. It's great. You know, like, hey, I bought this property. I bought this property in San Francisco using my credit cards, because they start out with credit cards and how they use credit cards to do it, because they want you later to use their credit card to buy their course.
Oh, they have a credit card they offer.
Well, they
use
show
your credit
you how
card to buy your. Okay,
yeah,
gotcha.
or they show you how to set up the credit cards right away.
Man,
so
that makes me angry. It just sounds like straight up predatory, like in some ways.
Yeah.
I mean, I haven't seen them, but
yeah. And I'm not saying it doesn't work for some, but it doesn't work for most, because the majority of it is like, hey, here's a course, good luck. And when I say slow, I guess I mean more like detailed. Like, someone could take the same approach that we just talked about, finding wholesalers and finding lenders, and do it in 2 weeks because they're focused and they have 8 hours a day. And there's other people like, you know, like me with 3 kids and running kids here and there and doing, like, I may have an hour a day. It's like, I can only do so much. Like, it's talk to 100 lenders. It's talk to 100 wholesalers. It's look at 200 properties. Some people could do that in 2 weeks. The majority of people take some time to consume it, look at it, understand it. So that's why when I say take it slow, it really means make sure you understand it all. Yeah, but some people can still do it quickly.
Gotcha. Yeah, that makes sense. You're saying like for most people to be able to do your due diligence,
yeah,
it might take some time when you're living your life.
Yeah, exactly.
In the meantime,
some people are working 2 jobs and trying to do this, and some people are running 4 kids around, and some people just don't. Some people have the time, but all they want to do, or all they can mentally put into it, is an hour or 2, and that's fine. It's just consistency. If you're consistently looking at properties and doing it, great. And finding lenders, great, because things are changing. The Fed is tightening everything. For 10 to 12 years, there was a whole generation of investors who is just easier, lower rates, properties going up. It's just the change is now happening.
Yeah.
And everything's tightening up. Lenders are disappearing. So there used to be a whole pool of lenders looking for everyone. Like, they would just throw money at everyone. Now there's this little pool, and they're like, yeah, I don't like you. I mean, like, they're getting selective. So to stand out, you're going to have to do a few things in this market. But guess what? This is also the market where the best deals come out. So the people who set themselves up in this kind of market are going to really win.
That makes sense, right? Like, once, you know, if interest rates come back down, if the Fed eventually loosens things up, then those who were able to, you know, be successful under the tighter, you know, environment will then be really successful. Is that what you're saying? Well,
yeah. You know, typically how markets work is when interest rates go way up, people can afford less. So home prices start coming down. Typically what happens is rates go up, property sales slow, and the property values either stop or they go down a little bit. So if you buy, and then there's this pent-up demand. There's people for a year and a half who are like, I can't buy. I'm living with my parents. I'm living with all these other people. What do I do? And then 18 months from now, rates go back down maybe to 5.5, and now they can afford it. Now there's this whole, you know, wave of people coming to the market buying properties. Guess what happens? Prices go So if you own a property, say you buy a property right now that used to sell for 400, now you buy for 350. And in 2 years, the wave comes back. It's more than likely that 400,000 you bought for 350 is going to probably sell for 450 or 5 in 2 years. I mean, that's a great return.
Yeah.
And that's what happens in these cycles is when people start running away, they stop buying, the smart investors come in, buy in this time and hold until they could get better rates than to, or they could sell or do whatever. And they enjoy life for a little bit. I helped someone in 2010 buy 10 homes in 1 year, and it put him in retirement. And he put nothing into them because he bought them at such good numbers, and they cash flowed way back then. And then 12 years later, they all had at least 3x'd. Some of them had 4x the value, and so did the rents.
Oh, that's awesome.
And they were cash flowing $500 a month back then. You know, he set himself up in 1 year for the rest of his life because he bought when everyone else was running.
So you said they were $500 a month.
I'm sorry, $500 cash flow. So after he paid his mortgage and everything, he brought home $500 on each property every month. That was his positive cash flow on that property. When I talked to him in 2022, he only owed on 3 properties. He had paid 7 off. Rents had gone up, values had gone up. He's just enjoying life. It just on 10 regular homes up in Thornton, in Westminster, up in Colorado.
Does he rent? So he rents them out?
He rents them all out, yeah.
That sounds awesome. Can you tell me how people could do that? Is it possible to do something like that when you don't have a lot of savings? Like, because you're talking about leverage, using other people's money. Can an average person who doesn't have a lot of their own money use leverage to go out there and buy 5 to 10 homes? I mean, I know you said take it slow, but at some point you get to that place. Like, what's the game plan to get there?
Well, there's always an exception to every rule, and everyone will say like 2010 was different than now. But this year alone, we've helped a couple. Basically she's driven the ship, but it's a couple in northern Oklahoma, and they have already purchased 8 properties, refinanced 5, have them all rented, and they're about to buy 5 more. So this year, there'll be somewhere between 10 and 15 properties that they purchased with little to no money. Once again, they're in a smaller community. The properties were smaller. Us as a lender liked the properties and what they were doing, so we could finance more or finance all of it. And then they rolled them into a long-term loan, paid us off, and then did it again. So maybe in some markets it's a little tougher because of the price points, but it is still happening in a lot of the smaller communities and smaller markets where people are finding properties at 50, 60 cents on the dollar. Lenders who like that kind of those numbers and leverage, they could fund 100% of it. The purchase, the rehab, get it rented, and then they refinance it into a long-term loan, pay us completely off. They have nothing into them. So those are still out there and they're still available. You just have to be more flexible in where you look. Like, we're in the Denver market. Finding those would take you, like 10 of them would probably take you 3 to 5 years that you could buy.
For the 50, 60, 70 cents on the dollar that makes a lender and that's the condition you need. You need to be able to buy something beneath market value.
Like 70 cents and below what market value is
and then a lender is jumping at it to provide 100% funding.
Well, it's just like any other product. Money is just like any bank. Every bank has their own, like, what they like and what they don't like, and like what they're conservative on and not. There are lenders out there, yes, just like we do some of those 100% financing on deals. The majority don't, but there's still a good 10 to 20% of the lenders out there who do. That's where when I'm telling, like, how do you set this up and how do you do it right? You have to reach out to so many lenders. You have to, get involved in networks and find out who is doing that, because the majority of them who are doing them are busy enough that they're not advertising a lot. They're not out there searching.
Gotcha.
Because the majority of them are going to want 10% to 20% of your own money in, which is still not, depending on the price point, it's what some people still could do, but it's a little bit harder. If you could do 100%, we just did 3 loans for a person who buys homes. He's more of a wholesaler this month in August. and we did 100% finance because he bought them at great numbers. Now he is flipping, he's selling all of them. He's not going to keep them, but all three of those properties would have met the criteria where he had nothing in, refinanced them out and kept them. But with where interest rates are and they're $500,000 homes, cash flow is what is keeping them from doing that at this point in time. Another point is just like his, is if you could afford to hold those and probably break even for a couple of years, and when rates come back down and you refinance them into better rates, then your cash flow will kick in. So people who could buy under market properties right now and at least break even, in a couple of years when rates come back down, they're going to be in a great position because they have a lot of equity and now they cash flow too.
So then they could sell their properties for a profit, use that profit to and then their cash flow that they can use to get more funding for new properties.
Yeah, that's true too. But I'm just let's look at an example. Let's say someone bought a house and they have a $400,000 mortgage and rates right now are 7%, and that payment, and I have no clue, but I'm just going to say it's $3,000 a month. In 2 years, rates go back down to 5%. If they just did a straight refinance, just paid off their old mortgage with a new mortgage at 5%, that payment will probably go down $500 to $1,000 a month. So they kept the same house, they kept the same mortgage, they just refinanced into a better rate, and now their cash flow is increased. Like I said, it's somewhere in there that we see this happen all the time. People will buy properties that are under market, and when times like this, they may break even. But then when rates come back down, they'll be able to refinance those properties and their cash flow goes way up. You just can't rely on cash flow for those properties during that time. But it is a strategy to pick up properties where other people won't look at it because they want cash flow. But if you're an investor who's like, I'm making money on my job, I'm making money on here, I want a future, I want this to be my 401k or some income in the future, you can start picking up properties now.
Gotcha. So you're saying
in the next 6 to 12 months.
Okay, so in the next 6 to 12 months, you're not expecting to make the kind of money that you would in a different economic environment, but you're saying that it's a future investment because
it's exponential for the future.
Yeah.
Because let's go through an example again. Something that's $400,000, that you could buy for $350 now, and in 2 years it's probably going to be worth $450 or $500. So if you bought 10 of those, at $350 right now you may have $50,000 in equity per property, $500,000. In 2 years, you just shot up to $1.5 million in equity, in net worth, you just created over $1 million for yourself that you could leverage. You could do many things with because you were able to buy under market and just at least break even, tread water, let's call it. And then when the market took off, you could either sell that property and make it, or you could keep it because when you refinance it, because you're either creating wealth or cash flow, and sometimes in rentals both. But if you're buying properties and selling them, that's just you're just creating. It's kind of like changing your payroll for selling homes. Every year I sell 4 homes. I make $40,000 on each home. That's my income, and I use it. I put my money away in my retirement. I spend some of it. It's just like taking over for your business. Other people do rentals where they might make some money every month, or they make money every month, but at the end of it, they still own the properties. And maybe when they retire, they own 10 homes, and maybe they'll sell a home every 5 years to pay their retirement, or they refinance a home every 5 to 10 years. That's kind of like another 401k bucket besides this.
That makes sense, yeah.
So you're either flipping the properties quickly and using the money now, or it's going to be long-term. And there's people who do both. Like they use the flips to pay their bills, and they buy rentals for, I call it the retirement fund.
Yeah, that's the retirement fund.
Yeah.
It seems like I'll speak for myself. Like the impediment to me going out and doing this right now is I have no idea how to have more than one loan. Like it would already be kind of the biggest financial undertaking of my life to like go get a mortgage and get a house. So like, how do you make the switch in your mind, and what do people have to go through to get more than one loan? Like to have, to have 4 houses. Like I don't even know how that would work, loan wise.
And I think that's a huge question a lot of people go through and ask, because we even had one gentleman yesterday who's house hacking. And he's like, how do I buy the next one? So we kind of went through, but the short answer is this: these loans are business loans. So the business has to take care of them. They have to pay the bills. And if the property, like we said, like making sure you have good properties that meet all your numbers. If that business and that property does not pay for its own mortgage, doesn't pay for its own fix-up, all that other stuff, then you don't do it, so it doesn't become a burden to you. So when you get into a investment and take out a loan, you have to make sure that business, which is that home, covers everything on that loan so it doesn't become something that you're going to have to work extra to pay.
So what do you mean it covers everything?
So let's just say it's a rental property and you take out a loan. The rents have to pay not only the mortgage payment, because that's what you're looking at. They have to, if you have a mortgage payment of $2,000, you need rents maybe of $2,500. So it pays your mortgage and it gives you a little bit of money in case there's some fix up or you need to spend. But at no time should that little entity, that house, cost you money out of your personal life. So that's why I'm saying be safe and secure, because there's homes out there that the mortgage is $1,000 and they're bringing in $2,000 a month. So it pays the mortgage, so it's not, and it gives you money.
That's what you mean by business. Yeah, just basic business principles. Bring in more than you're spending.
Yep.
Okay.
Don't get into properties unless there's always uniquenesses. We had a client who they were making so much W-2, almost $1 million W-2, they're buying properties to lose money. Or just to write off.
So they could go back into a different tax bracket.
Yeah. But that's not where most people are. They're in the same situation as you. Is like, how do I buy multiple properties? House hacking is another way that people start in this slowly.
What is house hacking?
House hacking is you buy a property that is, once again, a value add, something that needs some work. The gentleman I talked to yesterday, or email back and forth, he has a duplex. He bought it. He fixed up one side, rented it out, moved to the other side, and he did it with an owner-occupied loan, not a loan from an investor kind of lender.
And those have lower interest rates, right?
And he got into it for 100%, like an FHA or VA. So he put little to no money for the purchase of it. He's had to bootstrap the fix-up. Once he's done with that property, he's going to buy another owner-occupied property. He bought this with owner-occupied loan. He's going to get a second renter in, so both properties are rented. Then he's going to go buy another duplex or triplex with an owner-occupied high leverage loan. So he could, once again, maybe be in at 95 or 97%. And the owner-occupied loans have better interest rates. They're usually about a point better than a rental loan. So every year he's buying a different, or every year and a half, he's just buying a property, fixing it up, then getting rented, then buying another one with an owner-occupied and buying another one. I helped a doctor here. She bought, I think it was 5 or 6 duplexes and triplexes. And with doctors, they get 100% financing. The banks, for some reason, love doctors and dentists. So every year to year and a half, she would buy a new duplex or triplex, live in one unit, and then go to the next one and buy it with 100% financing from a bank and then 100%. So she lives in them so she could get better financing. And then she goes to the next one. It's slower, but those who have less money, you could go buy a house right now or a condo with your owner occupied, maybe FHA or whatever, and you could live in it. And if it cash, like in a year, 6 months, whatever, you decide we want to move to a townhome or a house, you can rent that out so it covers itself and then go and qualify for a new house.
Oh, okay. So that's the step for me.
That's house hacking.
Okay, that's between 1 and 2. That's where it seems hard. It could go from one property to 2, and you're saying that if you start renting out the first property,
so it covers, it's like its own unit, it's paying for itself.
Would you go live somewhere else while you get that set up? Like move back in with the folks while you're renting that property? Or really once you have it on paper that it's going to be rented, you move out and the bank would...
You do that, or you buy, like in a lot of these cases, they're buying multi-tenant units, like it's duplex or triplex.
Okay, gotcha.
So they may buy a triplex that already has 2 people renting. Maybe they're there and those units need fixed up, or maybe they don't, but they're willing to stay there for a while, and it covers your mortgage on your new property. So you can move in there, rent this one out, and both of them are being paid for. So like, let's just say your mortgage over here is $2,400 on this new property you're gonna move into. Mm-hmm. And you have 2 renters because you have a triplex, 3 units. And each one pays $1,200. So they're going to pay your whole mortgage. you're going to live in the other unit, fix it up, do whatever you need. You're going to rent your other property and maybe you have a mortgage on there for $1,500 and you rent it for $1,800. So once again, you're not paying either mortgage out of your income. The property's paying for itself because they're separate units. In that case, then once you get to the next one, you could rent out that third one, and now you have $3,600 coming in, and so you have more money coming in. You could buy the next property, and then so as it grows, the numbers, the compounding grows, and you could buy more properties.
So it's about being able to show the bank that you have either getting rental income or you just have to have cash flow.
Yeah.
Right. So if you have cash flow, you can prove to a lender that you can have 2 mortgages now.
Yep.
Okay. And then 3 and then 4. It's just learning to play that game. And it seems like the research component you're mentioning earlier is really important too, because I imagine situations like that are like people are jumping for those. Like if they're two people
Yep.
living in a triplex, you get the third and you own the whole thing. I imagine it's pretty competitive.
It is, and what people are doing, and they're changing laws here, and then like Minneapolis started it. But what a lot of people are even doing is they're buying a house that they're living in, and they may convert the basement into a rental. So then they have a rental going while they're actually living there. So they've created 2 units out of 1 while
Gotcha.
they're living there.
Yeah,
And then
yeah.
when they move, or they build something, like they take a garage and they convert it into what they call an ADU, which is another rental unit. And they could rent that out. Instead of having a garage, they have another rental. So maybe they got into a single family with an owner occupied. They switched it up. Now there's 3 different rentals coming in, and then they move on to the next one. The biggest thing is to make sure you take the emotions out and you understand that property has to pay for itself. Because if you feel good that property is bringing in $4,000 and it's only costing you $2,000, you could mentally go like, hey, I could get another mortgage because it's not going to be a burden to me.
Yeah.
And I can house hack to the next one or whatever. So it doesn't matter if you're house hacking or whatever. You have to make sure you're comfortable with the numbers and that is going to make you money. People get so emotional because they're like, they either get the greed emotion, like I'm going to make $1 million this year, and they're like, I'm going to do this and this and this, and then they end up losing $1 million, whatever. Or they get so trapped in all the emotions and it gets to them, they just never start in doing it. And sometimes there's little steps you could do, like house hacking, joining and working with someone who's already in the business, who's doing a good job, combining with them and learning as they go, like, hey, how do you fix this up? Because the other part of buying and selling properties, especially on the flip side, is making sure the properties are sellable. There's people who buy properties and do such a bad job, like they go in and fix them, but they don't fix them. They just put lipstick on, or they're just covering stuff up, and people in markets like this notice that and they don't sell. Like, you still have to have a product that someone wants to buy.
Yeah.
So there's components, and you have to have like I've seen people, like every bathroom they just went and got the clearance items and everything was mismatched and everything, and people are like, just got to start over. Like there's a reason that it is easy not simple, or simple not easy. However, it goes to that you still have to take the steps, and you have to take the steps till you're comfortable enough to eliminate as much emotion as you can, as far as the bad emotion that's going to get you into doing stuff you shouldn't do.
Yeah, I can see the greed playing out in terms of like that person that just used the clearance items in the bathroom. It's like, oh, I could make more money. It's like sounds like just being having a solid business mind about the whole thing. Like knowing that people, in media terms, right, respecting your audience, people are going to walk in there and be like, this bathroom looks terrible.
Yep. And 5 years ago, people were bidding on everything. It didn't matter.
Oh, okay, so this is different.
Times have changed now. Rates are charged, so people are being more selective because they can't afford. If they're going to pay that high interest rate, they want a nice property. They want to move into a property and live there for a while without having handymen over all the time fixing stuff.
That's how my wife is. That's what she says about everything. Like, this has got to be immediate move-inable. Yeah. That's what she says when we've looked at places. So yeah.
And that's the way most people are. They're busy enough that they don't want to do that.
Yeah.
So you have to take that into account when you're starting this whole thing. And that's why I say the 3 months is great too, because you can learn and understand not only like finding properties, looking at them, but how do you make sure and look at people's finishes and how they do and what's selling. We still have properties in certain areas that are selling in days, and some properties are taking months. And the biggest difference is the wow factor, just moving in. And a lot of it is easy. It's just, having an eye for.
It's just the wow factor.
Yeah.
That's what you see as the difference between few days selling and
exactly
months.
Yeah. Like, I could skip that. I could keep the old cabinets and not paint them. And people walk in going like, yeah, this cabinet's kind of stink. Mm-hmm. Compared to people who paint them or redo them. It's what happens. It's reality.
So for flippers, they definitely need to be invest in doing good work when they're flipping, so that people will like what they see.
Get help.
Quality.
Get help from realtors. Get help from people who design, or just go online and take what other people do, grays and blues, and keep it all the same. A lot of people want to make every bathroom different, every kitchen, just keep it all the same, and people love that.
Yeah. So where do I go from here with you guys? If my wife and I really want to do this, what's the next step for anybody that's interested in what you've been talking about?
Well, I think the next step is sitting down and just spending 20 minutes and going through this and understanding both sides. Because like I said, there's the buy side where you have to buy good properties, but just as important, you have to have the right leverage, because every property, every deal may have a little bit different uniquenesses. Wow. May have a little bit more uniqueness to them. So you have to make sure you have different lenders for different stages of your investment too, because as beginners, you need lenders and leverage that'll work with the beginners. And how do you set that up? How do you make sure you have enough, as we call it, buckets of money? There's a bucket that for the whole project, you have to bring some things to the table, like a credit score, maybe a little bit of money for the down, so what does your bucket look like? It's structuring it correctly. But then how do you also find the properties? It's like you're doing both at the same time.
Gotcha.
Some people want to get approved first and then go out and look at properties. Some want to go look at properties and find. I think you do both. You're testing the waters on both. And if the best deal in the world pops up, there's lenders like us out there who will help you. But more likely you're going to find that you're going to need and look through a lot of properties.
So that initial 20 minutes, is that what a client does? They come in to talk to you? That's the first meeting you have?
And our whole thing is let's run through a real deal. You go out and find a deal I want to flip this property, and let's run through the numbers so you understand the numbers, how much you could leverage, how much you would maybe need to bring yourself. Is this a good deal, and why not? So I think the first thing always is to sit down with someone. 20 minutes should be enough time to sit down with someone, walk through it, and see that you have your leverage and you're also working on finding your properties.
Nice. And where can people go to set up a meeting like that with you?
Just on our website, thecashflowcompany.com, there's a calendar page, or just in the quick inquiry too, if you just have a question. Just a little form you fill out, and you put in the information you want. And we typically get back to everyone in 24 hours, business hours.
And that's just right there on the site?
Right
quick
there.
Inquiry?
Yep.
Awesome. Well, thanks, Mike. This has been fun. I will shake around the mic awkwardly.